Hey everyone, welcome back to the Chain Reaction Podcast. I'm your host, Tom Shaughnessy, a co-founder at Delphi Digital, which is an independent research boutique providing institutional-grade analysis on the digital asset market. One quick housekeeping item before we get started. This podcast is strictly informational and educational and is not investment advice or a solicitation to buy or sell any tokens or securities or to make any financial decisions. For full disclosures, please see the bottom of the show notes. Also, our listeners can visit delphidigital.io and use coupon code ChainReaction as a special offer to access our research while this offer lasts. With that out of the way, today I'm thrilled to have on Andy Bromberg, the co-founder and president of CoinList's. Andy is one of the most insightful guests I've had on. His ability to distill everything happening in crypto into digestible and understandable pieces is remarkable. On this episode, we covered so much, including the future of funding, developer-focused community building, a complete rundown of CoinList's, and how CoinList's only accepts 0.02% of the projects it's approached by. We also discuss governance, competition, and regulations. This episode is worth a listen and a share. So with that, let's jump into the episode with Andy. Hey everyone, welcome back to the podcast. Today I'm thrilled to have on very special guest, Andy Bromberg, the co-founder and president of CoinList's. How's it going, Andy?
Good, thanks for having me on.
Yeah, it's great to have you on. So just give us your quick intro, Andy, how you got started in crypto and how you got to CoinList's.
Yeah, sure thing. So I got started in crypto back in 2012, 2013. I was studying at Stanford, math, computer science. I took a class taught by an amazing professor named Balaji Srinivasan, who's now the CTO of Coinbase, formerly the CEO of Earn.com. And before that, he was a partner at Andreessen Horowitz. And he taught a class called Startup Engineering. And afterwards, a bunch of the folks in that class and him kept spending time together. And he ended up convincing us that Bitcoin was going to be really important. And it was really just Bitcoin at that point, back in 2012, 2013. There weren't a whole lot of other tokens out there. And so we formed the Stanford Bitcoin group back then. Did a lot of research, academic research, advocacy work, built some cool projects, ran that for a few years, ended up leaving school, started a company not at all in the crypto space called Sidewire in the political media space, ran that for a few years. And then as CoinList's was getting started up in the middle of 2017, I came over and joined as one of the founders of CoinList's as it spun out from AngelList towards the end of 2017. And we've been working on it ever since.
It's awesome. So how much skepticism did you have early on in that class? Was it kind of like you were just instantly sold, or did it take some convincing?
No, it took some convincing. It was one of those things where I think the group of us thought Bitcoin was interesting, but not that interesting. And Balaji really hammered us on it and convinced us that it was worthwhile to spend a bunch of time doing it. And then as soon as we really dove in and started meeting people in the space and doing research and thinking about the implications of what this sort of new asset could mean, then we all got really, really interested. And most of us are still in the crypto space today.
Wow. And what was the main issue you had or main skepticism you had at that time? Was it scaling kind of like today, or was it just, what the hell is this?
Yeah, I think it was the latter. It was, why does this need to exist? What problem does it solve? And in those days, and I regret not being immediately sold, obviously, but in those days, I think it was a little bit less obvious. There were fewer designated use cases. There were fewer people that had done good thinking about how the space would evolve. And so you really did have to use your imagination. And at some point, this idea of sovereign grade censorship resistance and this asset that can transact anywhere in the world near instantly, those were the things that ended up getting us across the finish line as being really interesting. I think from the beginning, for me, things like scalability and some of the problems that people cite with Bitcoin and other digital assets, those have always felt like implementation problems to me, where none of them feel like they're going to be showstoppers for the space. They're just something we have to solve at some point. So those were never the issue. The issue was always, in those earliest days as we were getting on board, was much more around, does this matter? Does it need to exist? And once we got there, everything else has been a straight line ever since.
So you've been around the space for a while. So before we jump into CoinList's, I'm interested. What's your take on the plethora of projects around today versus, back when you started or back when you got involved? Do you think that, we have too many projects today? Do you think that a lot of them are just going to fade away kind of like they do every year? What's your take on the ecosystem here?
Yeah, it's an interesting question. I think it is. There's a very low signal to noise ratio in this space historically, and I think I would really break it down into two categories. One is, bad actors, fraudsters, scammers, of which many have entered the space at several different times in crypto's history. But I think most prominently and publicly in kind of 2017 and early 2018 through the ICO hype period, there were just a lot of bad actors in there trying to make a quick buck with no real intentions to successfully execute on a project, or at least no real plans to successfully execute on a project going forward. And I fully expect those people to filter out of the ecosystem. In fact, I think the recent downturn has caused a lot of them to leave. And we've really seen that bottom of the market drop out, which to me is a net positive for the space to see a trend towards quality. But I do think on top of that, even if you eliminate these bad actors and fraudsters and scammers, still a lot of crypto projects, even those built by strong operators with good ideas, are going to fail. And it's just like the startup space, where a lot of interesting startups fail for a number of different reasons. And crypto projects will too. And so just because a team is a strong team and has a good product and interesting market does not guarantee by any stretch of the imagination that they're going to succeed. So I think we'll always see attrition in the crypto space, even outside of these cycles of good and bad actors varying in numbers. We'll always see a lot of crypto projects fail, and that's the name of the game in early stage innovation and launching something from the ground up.
Makes a lot of sense. I definitely agree with quality over quantity, and that's a great segue into CoinList. I mean, give us the quick takeaway for those who are unaware. I mean, they're probably hiding under a rock at this point, but on what CoinList does and your focus here.
Yeah, so CoinList is working towards being the place where the best digital asset companies manage their token sales, airdrops, hackathons, and everything else. Ultimately, we want to be a one-stop shop and a trusted advisor for token issuers as they go about their business. And a little bit more practically, today that means we do a couple things. One is around token sales themselves, and this is what we're most known for. So we have a couple different services that aim to help token issuers facilitate their token sales. That means doing things like compliance due diligence on their investors, so KYC and AML. It means things like accreditation checks. It means processing transactions and helping them sign documents and doing all of the kind of minutia and logistics work that's required for a token sale. And then additionally, in certain cases, we'll offer marketing services as well to these issuers for certain customers. So that's one set of services is around token sales. The second column of our business right now that we're working on is around building community and building network growth. And so the first product we launched there was around airdrops. So we helped the Definity team with their $35 million notional airdrop to tens of thousands of users and participants, future participants in the network. And that's really around building awareness and rewarding users who are doing good things with tokens. And so we've got this airdrop service. And then even more recently, we launched a online hackathon service called CoinList's Build. We've ran hackathons with 0x and NewCypher this year already, and have a number of others coming up. And that's really focused around building developer communities and building networks of these developers that are going to actually build on top of these underlying protocols. And so, just circling back, we've got token sale services around actually helping with offerings, and then we've got services around building community, whether that's broad-based airdrops or it's more niche network growth via engaging developers to build on the platform.
So you guys have some of the most high-profile launches in the space. I think most people would agree with that. I mean, you've had Filecoin, Blockstack, a lot of others. What's kind of the number of potential deals versus the deals that you do? I'm assuming the number is obviously really low. I'm just wondering how you guys back into that and how you weed out potential bad deals or ideas here.
Yeah, so we have publicly, on the token sale service side, publicly we've worked with 6 issuers, a half dozen issuers in the past year and a half, out of about roughly 3,000 inbound leads. So that's a very low ratio. We've also helped dozens of issuers privately with their token sales, but only 6 publicly. And I think, when I think about separating signal from noise in the space, I look at it from the perspective of a smart investor and think about what that smart investor would do to diligence a project. Because for us, we always tell our community, you've got to do your own diligence on top of any vetting that we've happened to do, but ultimately this is your investment decision. You have to do your diligence. And the diligence that I think a smart investor does on token projects breaks down into 6 categories. And I'll run through them really quickly. The first 4 are the exact same things that I would say are smart to evaluate for any early stage investments, whether it's tokens or it's a normal startup that you're investing in equity for. You got to look at the team and the strength of the team. You got to look at the product and how compelling the product is. You have to look at the market, the size of the market, and you have to look at the deal terms. Do the deal terms make sense for what you're getting? So those 4 criteria you would look at for any startup or for any crypto project. And that's kind of a baseline. And then there's 2 extra layers that I think you have to look at when evaluating a crypto project as opposed to a startup. And the first is the legal structure. So when you invest in a startup, there's really no innovation on the legal structure for how that investment is made. Everyone uses roughly the same documents. There's no creativity there. In crypto, as we've seen, there is constant innovation on the legal side. And so you have to get really comfortable with how the token issuer has structured the issuance and sale of tokens and the tokens themselves. And that's something that I think a smart investor would vet. And then the last piece, and maybe the most interesting one, is the token economic model. And that is it's a very overloaded term. It means a lot of things. But this is maybe the most interesting piece to evaluate when you're looking at a crypto project. And from my perspective, it means a couple things. One is, will the token accrue value in the long term if the network is successful? Said another way, you're looking at the product, looking at the market, and you're saying, yeah, I think this distributed network is going to be really successful. A lot of people are going to use it for its intended use case. But then there's the secondary question of, okay, assuming that happens, will the token used on the network actually accrue value? Will it be worth more in the long run? And from my perspective, there have been a lot of projects in the space that, again, compelling team, compelling product, compelling market. And then I look at that question and I say, I just don't see how this token is going to be worth something in the long run. And so that's a really important piece of the token economic model. And then the second piece of the token economic model that you have to look at is, as an investor, is are the incentives on the network aligned well? And when you think about it, token networks are really a system to encourage a distributed and decentralized set of people to act in a certain way. So on the Bitcoin network, you need people to mine, but there's no central party saying you and you and you have to mine. It's just that the network incentives have to be aligned such that people will actually keep mining. And so you need to make sure that on the network, the incentives are set up such that all of the necessary parties, so folks like miners, are properly incentivized to do so. And at the same time, there are proper penalties for people that are trying to attack the network or doing bad things to the network. And so that's how we think about that. And again, just going through that basic criteria: team, product, market, deal terms. And then on top of that, the legal structure, and then some of these really in the weeds, really interesting new frontier token economic items that you have to look at as an investor.
Makes a lot of sense. I like how you kind of pointed out the crypto economic nature there. I always point to Stellar when people want to talk about a project that could be amazing for the world, but very questionable on how it'll accrue value. But just one other thing, I have a question for you on here. How do you guys think about governance? Does this play into kind of how you weed out projects, or is it kind of more of a long-term thing that you're not too concerned about now?
Right. It's an interesting one. I think there's really 2 types of governance that you have to look at as an investor in the space. One is on-chain network governance, and the other is token issuer company governance. And I think in different circles, both of those can be underrated. When I talk about on-chain network governance, that's talking about, again, if the incentives of this network have to change over time, if the rules in this network have to change over time, how are those changes actually made? And understanding that, you're absolutely right, is really important for figuring out if something's a good investment or not. And if the governance is not set up well, then there's a good chance the network's going to have real difficulties at some point in the future when things hit a rough patch. But then on top of that, these tokens, when you run a token sale, there's an issuer that is selling those tokens, and they are taking in money, usually to finance the development of the token network. And you have to make sure also that the governance of that company itself is well run. And it's something that you talk about a lot in normal startup investing, making sure there's a strong board and that there's a good management team, all of these pieces that are core to ensuring that the outcome is going to be good. I think it's been underrated in the crypto space a little bit. So, you also have to look at what is the governance of the team that's actually getting the capital and looking to invest in the development of the network.
Yeah, that's interesting. I mean, it just seems like we're coming to a head with a lot of governance debates. I think MakerDAO is kind of trying to redo their board right now, and then we have Ethereum with Constantinople being delayed, and we're just seeing other networks kind of solve these issues in a way. Like Tezos's Athens vote is going on perfectly, and Decred is using its treasury with allowing token holders to vote to use that. Do you think governance is a short-term problem right now until these networks grow, or do you think it's always going to be kind of a contentious point?
I think there's always going to be experimentation. I think there will always be contention. There's still contention in world governments today, unsurprisingly, as people are fickle and there's always changing situations. But I do think what we will get is over time is a more established set of paradigms and building blocks for effective governance. Right now, it feels like we are so early in this question of how you effectively run on-chain or network governance, and the building blocks just aren't there. And so I think over time, those will start to develop. We'll start to see successful cases where certain networks have had really good governance as they get more mature. And then future governance will be based off of those concepts. And of course, there will always be contention. There will always be debate. There will always be issues, but it will get more and more stable over time. But I do think we're in the earliest days of experimenting with network governance right now. So there's a lot of unanswered questions.
Totally agreed there. And just to round this out, I mean, do you have a personal view on which scenario you think will win? Like, do you think that Ethereum's off-chain governance could, beat Tezos's on-chain governance over time? I'm just wondering, your take there.
I think there's going to be a lot of players in the field for a long time. And, as we see with any business, and I feel like I often draw analogies back from the crypto space back to the traditional world, whether it's business or politics or anything else, there's always cycles. And you have, one reserve currency for a certain length of time, and then it cycles out and there's a new reserve currency, or one party in power and then there's a new party in power, or one dominant company in a space and then there's a new dominant company. And I think as times change, as people change, as trends change, you'll certainly see turnover in the dominant player in any given space. But for the time being, I'm not sure that I have a strong thesis on which of those directions is going to play out best in the long term. I think there's a lot of experimentation left to do.
Got it. So let's switch back to CoinList for a second. I mean, you guys do a lot, and I've had on a lot of the security token CEOs. I'm just wondering, what in your mind sets CoinList apart the most from your competitors in your mind? Yeah.
So, the security token term is an interesting one. It's one that I actually take a little bit of issue with because I think that the space has, and this happens in any early stage space, but terminology has gotten very confused as to what all of these words mean. You hear utility tokens, security tokens, and people have different definitions of what that means. And just to give you an example, so for most of the projects that have happened on CoinList, at least publicly, they have been offerings of securities. So the issuer has sold some sort of security, usually something like a SAFT, that represents future ownership of tokens. And those tokens, in most cases on CoinList, are intended to eventually become non-securities. So Filecoin is a great example. They sold a SAFT to investors, which was absolutely a security, and they treated it as such. But the Filecoin token in the end is intended to be a non-security. So I've had people come to us at CoinList and say, CoinList has only run security token offerings because we've only run offerings for securities. When are you going to run a non-security token offering? And at the same time, I've had people come to us and say, CoinList has only run non-security token offerings because those tokens are not intended to eventually be securities. When is CoinList going to do a security token offering? And so those are diametrically opposed. People are using the exact same terms to mean very different things. And so I'd like to redefine that a little bit. For me, when I hear security token, what that means is a token that is and will always be a security. So this is most commonly talked about as these sorts of asset-backed tokens, whether it's a real estate-backed token or a startup equity-backed token. It's some sort of token that represents an underlying security. And for me, that is a security token. It's a token that's a security. It will always be a security. And then Separately, there are these other things. So there are securities that represent future ownership of non-securities tokens like SAFTs, transitioning to something like Filecoin. There are just straight up non-securities tokens, or there may be tokens that are not and will never be securities. CoinList has not currently dealt with any of those. So that's just kind of the first thing I wanted to lay out in terms of terminology and how we differentiate. I think in terms of competitors, we offer a bunch of different services. And for us, we see ourselves as the best place to go and facilitate your token sale if you are a top quality digital asset issuer. We've worked with the best people so far: Filecoin, Blockstack, Props, Origin, Trust Token, Ocean Protocol, and are continuing to keep a really high bar on vetting projects before we work with them. And when you come to us and actually use our platform, we think we have the best compliance infrastructure, the best transaction processing infrastructure, the best community that we're able to market to, and be able to outperform anyone else on whatever facet you need with a token sale. But one important caveat, and a place that we're not competitive, is we are currently not helping to tokenize assets. So there's a bunch of people out there that actually work on taking assets and turning them into tokens. And that's not our business. So we don't even compete on that. Those people can then come to us and see about facilitating the token sale of that tokenized asset on CoinList. But for the time being, that's not something we currently do.
Got it. Yeah, I mean, I always thought of you guys as the premier kind of utility token type platform, whereas tokenizing real world assets is more in the wheelhouse of, say, Securitize or Harbor or Polymath, what have you. Why have you guys decided not to attack the tokenizing the real world asset space? In my mind, that market is always better for real world assets than for, say, blockchain itself. But I'm interested in your take.
Yeah, so it's a really interesting market, the asset-backed token market. Our view is that it's just a little bit too early for it right now. And I have a lot of belief that it's going to happen in the long run. I'm very glad that there are awesome people working on it and building out infrastructure for tokenizing assets. But I just don't see the investor demand for those assets right now. And so we've kind of made the business decision that we don't want to invest a bunch of resources in going and providing those services because we don't see the investor demand on the other side of the table. And I think that's a prerequisite for really seeing a flourishing asset-backed token ecosystem.
Got it. That makes sense. So, I mean, I guess this is a good segue to go into kind of the evolution of funding over the past couple of years, especially from your perspective. I mean, we had ICOs. Now we have IEOs, which I'm hoping doesn't turn into, the same bubble we had with ICOs. What's your take on where we are today and where we're headed on the fundraising spectrum?
Yeah, I think the fundraising structure that we're going to see is going to converge a lot more towards the traditional venture capital model, where there are smaller and then perhaps increasing in size sequenced raises based on milestone achievements. I don't think, in 2017, we saw a lot of one-time raises. Token issuers said, we're going to raise money. This is all we're ever going to need. That's not really something that happens in other industries. It doesn't really make a lot of sense. And so I think that was a product of the times and not something that we thought was going to last forever. So now what we're seeing a lot more is sequenced fundraisers where issuers are going and raising a little bit of money, building something out, having that as proof. They can go to the next level, raising again, doing that over time, and perhaps at some point going and doing some sort of public token sale in the same way that other equities go public. And that's how I'd expect to see that evolve. That's proven to be a really good model for early stage risky investments in the form of venture capital. And I see the token market as very, very similar. So that's how I would expect to see a majority of projects fundraise going forward. I also think that there are always exceptions to that rule. And you see this even in startups, that every once in a while someone will raise $100 million Series A very early on. And that will happen in the token space as well. But as a general rule, I would say we'll see smaller sequenced raises, a lot more private sales leading up to eventual public sales.
There's always a debate kind of in the VC or hedge fund type world in crypto on whether or not a fund itself should focus on tokens or equity investments. Without pointing out any names here, do you have any views on where you think that institutional kind of investment market will develop going forward? It seems, especially in the bear market, there's definitely more of a focus on equity type investments, I think.
I think that's right. I think there's really two questions here. One is, where will the investment come from into the crypto space or into companies developing tokens in the first place? And the second is, once you have that, how will that actually be structured? So on the first question, I think absolutely the venture capital market is a great place, and there's a lot of interest and demand for crypto startups, whether it's in the form of tokens or equity. So I think that's a big place where investment's going to come from. Also, individuals, angels, and there are a lot of people that have made significant returns in crypto that are interested in reinvesting in the ecosystem. So I think we'll see a lot of demand for these early stage projects from venture funds and angels, very similarly to how the startup ecosystem has developed there. But then there's this secondary question, which you were getting at, and I think it's a really good one. In what form will that investment come? Will it be in tokens themselves? Will it be in equity in the issuer? Will it be in something in between? I think that's largely an unanswered question right now. And I have to imagine it will converge on something like and it goes by a bunch of names, SAFT-E, SAFE-T. There's a whole bunch of different names for these legal documents, but some sort of document where either the investor gets equity and tokens, or some sort of option at some point in the future for equity or tokens. And it's just because it gives you a little bit of optionality. So you run into a case, this happened with a number of early crypto issuers where they sold SAFTs, giving ownership of future tokens, and then the company decided to not issue a token. And then the investors were not entitled to anything. And so that's obviously problematic. But at the same time, if the company's building a token and you only get equity and there's no kind of upside in the tokens there, that also does not seem right. And so either having a structure where you're getting both or an option on either direction feels like the most likely direction going forward.
Got it. That's excellent color. And, just taking it a step further on the institutional side, I mean, we talk to a lot of banks and firms in the traditional space on where they're going to get involved in the space. And it seems like, the Goldmans of the world could get more easily involved in crypto if they were involved with, say, the equity sales of these companies. Do you think that's fair and that could be a better on-ramp for them? Or do you think that they'll always kind of be at odds with the crypto space?
No, yeah, I think absolutely. And we have seen interest from lots of institutional players in participating in this space and some activity. I agree. I think equity is something, these traditional financial firms understand. It's a better starting place and a good place to ease them in. And then if that develops into more active token investing in the future, even better for the space. Got
it. And, this is another great segue into your views on the regulatory landscape. I mean, what's your take on the latest guidance from the SEC? And, I'm not sure whether you spend more of your time kind of wondering whether this affects the whole space or ICOs but I'm definitely interested in your take here.
Yeah, it's there's a lot there. I think our overall view has proven out to be, the assumptions we worked in from the beginning of CoinList's have proven out to be largely right, which is most, if not all, token sales are offerings of securities. And so we have, operated under that assumption and the issuers we've worked with have, and I think that's worked out really well. And the SEC has just continually reinforced that, including with the guidance that they released last week. So for us on our token sale side of the business, it feels like at that moment, there's not a lot of debate around what we should be doing there, what issuers should be doing there. There's not a lot of uncertainty. Where there is uncertainty is for these issuers like the ones I was talking about earlier, where at some point they intend to have a non-security token. They intend for their token to become a non-security. And the question is, how and when does that happen? For the first time, well, last year we heard some informal guidance, both from Director of Corporation Finance, Bill Hinman, and Chairman Jay Clayton of the SEC saying, it's possible for a token to make that transition from being a security to a non-security, which was great. So that's a really important first step. And the next step is, okay, how, when, where is that line actually drawn? Where does it become a non-security? So the SEC released guidance last week, as you alluded to. And in it, there were a number of criteria. I think my view on that is it's very helpful to see them thinking critically about this and starting to put some guidance out there. I don't know that the set of guidance that was released will make a material difference in anyone's evaluation of whether the token is a security or not. And I think we'll need to see more, specifically outlining more concrete points that will allow law firms and issuers and executive teams to make decisions about whether or not their token will be classified as a security. But it's a good first step. I think we'd like to see the waters continue to clear They feel a little muddy right now and a little bit ambiguous. And as that continues to happen, I think the space will see a lot of benefit from that.
I'm just wondering, building on that, what in your view is the point at which, say, a security token no longer becomes a security token? Like, do you agree that, say, Ethereum is so decentralized at this point that it can't be, say, taken down by the SEC, or do you think that's like still a vague gray area?
Yeah, I think there is. I don't know that there is a single line to be drawn, is I guess the key point there. I think there's a bunch of reasons that a token could not be a security. And we even saw that in the guidance last week that the SEC outlined a number of different criteria that would cause a token to be a security, a number of different criteria that would cause it to not be a security. So I don't think there is a simple metric where we can just say if X is true, then it is not a security. I think there's a number of factors that you'll need to consider. And ultimately, much of securities law relies on this concept, and especially this piece of it. It's a facts and circumstances based analysis. And so, what are the facts? What are the circumstances? Let's evaluate from there. And so there'll be a bunch of criteria. The SEC guidance last week did not mention this decentralization point that Director Hinman talked about last year, and so it's unclear how that's playing in their current analysis, whether or not that's a major factor, but. I don't know that we have a great barometer yet on where to draw that line in terms of any sort of simple explanation.
Got it. That makes sense. So let's switch gears a little bit to community building. I think it's really important in crypto. And I think we're kind of seeing, at least in my mind, we're kind of going from community building where we just had tons of free airdrops to kind of community building where founders are getting really competitive and vocal about their platforms. And my take there is, Ethereum 2.0, Polkadot, Cosmos, they're just constantly on Twitter arguing on where they fit in. What's your take on community building, a year ago versus today, and how important are airdrops in that world? Community
building is absolutely critical. These networks will not exist without communities. And so people that are doing well at that are building a real competitive advantage for themselves. I think the first thing you have to think about to your point, it feels like a lot of people did not think about in the early days of airdrops and community building is who's your audience? So if you're a base layer 1 protocol building some sort of smart contract platform, let's say, your audience is really not average consumers. The most important people for you are developers who are going to build applications on top of your protocol that consumers can actually use. Because faced with Ethereum or Polkadot or Cosmos or anything else, a consumer can buy the tokens to participate in the potential upside of the network and engage in a financial sense, but the average consumer is unlikely to actually use those tokens for anything until there are applications built on top of that network to use. And so I think the most important audience that those networks can get is application developers who are building on top of their protocol. And so that's where you see some of this more critical thinking coming in, is answering that basic marketing question of who's our audience and how can we target them. So I think what we're seeing now with airdrops, and certainly for us, is that that era of $1 airdrops to as many people as possible, that's over. That was a sign of the times and was beneficial for purposes back then, but is not actually helpful in really building a community. And so for us, airdrops look a little bit different right now. And I think one big difference is that they are often going to be targeted going forward. So it'll be something like, we are building a protocol that's going to be most used by data scientists. And we want data scientists on the platform. And so we're going to give $50 worth of tokens to every data scientist that signs up. All of a sudden, that's a really compelling proposition because you're targeting the right people. You're giving them a meaningful amount of tokens to actually use, and you're encouraging usage and building community. That is where I think a lot of these airdrops are going to go. And we often draw the parallel from airdrops to referral programs or even things like PayPal. In the early days, PayPal gave away $10 or $20 to everyone that signed up that was kind of a qualified user for that service. And it worked really well for growth because people would sign up, they would have $10, they'd pay a friend or pay a business, and then they would say, wow, that was a great experience, way better than any other option I have. Now let me go and put more money onto PayPal and keep using it. And that's how we expect these airdrops to happen, is targeted delivery of meaningful amounts of tokens to users that will use it. And then really importantly, this was a key piece of PayPal's success with what we sometimes call the PayPal airdrop before airdrops were a thing. PayPal's product was actually good and usable. And once people used it, they said, this is great, I want to use it more. And that's when the most effective airdrops are going to happen. When you give someone tokens that's actually a user or going to be a user of your network, they use it, and then the experience is genuinely good enough for them to come back and use it again. And so I think you both need to think about who your audience is for the airdrop, but also about making sure your timing's right and that your product is compelling enough for someone to actually come back and use again after they use those airdrop tokens.
So Andy, that's great color. I really like the idea with the targeted airdrops coupled with a solution that actually works. Where are we on, it seems like it's easier to do a targeted airdrop than it is to do an airdrop for a product or a service that's actually live and working. What's your take on that? Are we really there yet on a UX or a UI perspective for a lot of these projects?
I think it really varies on how the project's executed. So, for example, Definity actually airdropped before their network was even live to reward their community that had been with them for years, supporting them along the way. And those community members participated. And then at some point when the network launches, they'll get an email that says, hey, sign up for a wallet. Here you go. You can participate on the network now. And those tokens will be distributed right into it. So I think there are clever ways around some of the problems, a lot of smart people working on them. But I agree. One of the biggest things holding this space back right now is the quality of user experiences and the interaction paradigms that people are going through. And I'm very optimistic in the next 6, 12, 18 months, we're going to see that improve by leaps and bounds. We've seen amazing designers, developers, product builders get into the space. And I think that'll make all of these things much, much easier in the future.
That makes a lot of sense. And do you think that with these targeted airdrops, do you think that this is going to be, say, an Ethereum native market again? Or do you think we're going to move away from that where airdrops could be done for somebody that holds any type of crypto asset?
I think it could be absolutely anything. And part of it is that the airdrops are now participatory in some way in most cases. So before, you're right, it was a buck being sent to everyone on the Ethereum network, everyone that had some other token or something like that. So it was Ethereum native. But going forward, if you're doing things like only airdropping to data scientists or only airdropping to people that have participated in some other action, those people have had to engage somehow off-chain typically. And at that point, you can help them through the process of making a wallet for any asset. So I think it actually opens up the gates really widely for any network to be able to airdrop, regardless of whether or not it's on Ethereum, it's a separate layer 1 chain, it's on a different chain, whatever it may be, there'll be a lot more flexibility. Got
it. And your approach to airdrops, it seems to me, is more focused on the demand side of the network. We just wrote a DeFi and a gen mining piece, and we kind of looked at it from the supply side, and it seems like a lot of the supply side in gen mining is more of, somewhat of financial engineering to bootstrap the network, but you guys are focused more on getting users, getting engineers, getting data scientists involved. Do you think that you play in well with gen mining with airdrops, or do you think that CoinList may have to evolve to kind of target, both sides of the spectrum here?
Yeah, no, that's a cool one to think about. There is part of the issue when talking about any of these things. I admire your ability to interview people about it all day. Is they're so different project to project. And so, we try and talk about airdrops and how to use them and targeted airdrops, whatever it may be. But at the end of the day, each project needs something totally different. And sometimes even the act of participating in an airdrop needs to be really participatory. They need to actually do something on the network. Sometimes it doesn't. We've built our system just on a product level to be totally flexible to whatever needs to happen, whether it's as simple as clicking a button and getting tokens, or it's as complex as actually engaging with the network in some way in order to get tokens. So we're open to that. But I think the point I would make there is just that each of these networks is so different. And I don't know that we're going to converge on one paradigm because each of these tokens is used in such different ways. And so I think it's unfair to suggest that, as some people do, that all of these services are going to get standardized. They're going to be very different project to project.
Got it. That makes sense. So switching gears a little bit, I want to go back to kind of what you're seeing at CoinList in particular with projects and teams. Are you seeing a difference in the teams that approach you now versus the ones that did last year, the year before, or anything like that? My kind of gut take is that there were too many developers in the room, and now we're getting more, finance people in the room and project managers and things like that.
Yeah, I actually don't know that I would characterize it that way. I think there were a lot of business people seeking a quick buck in the room in the last big hype cycle. And so now we're seeing really product and building focused teams. So that means lots of developers. It means lots of product people. It means really operationally savvy folks across the board. And it again, really varies project to project. Each of these things, some of them are deeply technical endeavors. Some of them are less technical endeavors. But what's exciting to us is that the difference we're seeing is that just the quality, the percentage of high quality teams is so much higher than it was before. It may be, around the same absolute number of high quality teams, but there's just way fewer low quality teams in the space right now trying to do things like fundraise or build a community, which is making the signal to noise ratio way better than it ever has been.
Those trying to raise money or do a project, from your point of view, what are the quick things that when you see a project, you're like, absolutely not? Like, are there any quick things that help you quickly weed out projects when you're looking at them?
Yeah, you've got two answers to that question. One is there's a bunch of just very obvious red flags, and they're not even really crypto specific, but you can tell when you're dealing with people that are not in this for the long run, in it for a quick buck, fraudsters, scammers, people that say they've got something built and really have nothing built, people that are attacking a market that doesn't exist, people that are misusing the technology. So there's a bunch of red flags, but those are actually the less interesting ones for me because they're easy to dismiss. The much harder ones are the ones that have some sort of, in my eyes at least, perceived critical flaw, but are otherwise very good. And most often that comes, if we go back to those criteria that we were talking about earlier for investors to evaluate projects on, that goes back to the token economics piece. So, I've had a lot of conversations where it's a really strong operating team, well-composed, thoughtful people, really interesting product that seems really valuable. They're attacking a big market. The legal structure seems sane and thoughtful. And then you look at it and you just say, all of this makes sense, except that if this network is successful, which is a lot of work, could happen, but if it's successful, I don't think the token is going to be worth anything at that point. I don't think the token is going to accrue value commensurate with the network succeeding. And that's a really tough one. That's a massive red flag, obviously, for supporting a token project if you don't think the token's going to be valuable at some point in the future. And so that's, I think, the biggest struggle is when that red flag pops up of no token value accrual system on top of an otherwise excellent team product market. That's always the toughest red flag to see.
I guess it's hard, though, to differentiate between kind of, one's feeling that they want to help build the ecosystem versus, a project that has low token value accrual. I mean, are there any projects today that you think have excellent token value accrual, or is it still somewhat of a gray area?
Well, it's definitely a gray area in terms of how these token models are going to work. It's, again, so early for all of them. And a lot of questions to be answered. I think the token that has best demonstrated value accrual over time for me is Bitcoin. It has defined a use case in my eyes largely around being a store of value to date, and has indicated that as that use case adoption drives, the value of the token goes up. And I know it sounds kind of silly to call Bitcoin a token sometimes. It predated this whole token wave, but I really do think that's the one that has seen the most definitive success. And even then, there's still a lot of questions to be answered, but the most definitive success in terms of value accrual. And then everything else is in its testing phase, and we'll see what works. But you can have theses and beliefs about what's going to accrue value and what won't. And certainly there are a lot of projects and teams that are just working on ecosystem growth and not necessarily worried about token value accrual, which is totally fine. And in fact, excellent to see people building the ecosystem. But for an investor, if you're looking at investing in something in a token, you have to know that the value is going to accrue. And if it's not going to, then that token is probably not a good investment, regardless of the intentions of the team behind it.
When you're thinking about those projects that are building without the accrual in mind, how hard is it in your mind to implement new token economics or even new governance structures later on to kind of capture more value or to change decisions? And, in my mind, it's extremely hard. And we're kind of seeing that with 0x and MakerDAO right now or even Ethereum at the struggles of kind of handling governance once a network gets too large.
Yeah. No, I think you're right, and I think the answer is TBD. But we've not seen great participation in network activity, network votes, network governance so far, and that's an open problem that needs to be solved. So I do think, it's not that everything needs to be perfect on the day the network goes live, but I think you have to have a lot of stuff in the right ballpark, and in order to make those smaller changes over time.
Yeah, no, I totally agree. And, just zooming out, Andy, for a bit, what are the demand drivers you're looking at for crypto today? And I guess, are they different from what you were looking for a few years ago? I mean, I know the obvious ones are like an ETF or, clear regulatory approval, things like that. But are there any other crypto drivers that you're tracking closely or hoping that come online soon?
I think the biggest ones for me are internal to the crypto space. Real interesting use cases emerging. It felt like Bitcoin, wandered around the desert a little bit and then kind of found this store of value use case. And a lot of people, I think, would rightfully argue that may have been Satoshi's vision from the beginning. But certainly, I think it took a little while to settle into that, at least from a community perspective. And that happened, I think. Finding other great use cases for crypto that are really successful is the most important demand driver there is, because at the end of the day, these markets determine these prices, and there needs to be attention around them and excitement around them. There are a lot of exogenous factors, certainly things like ETF, certainly things like institutional interest, certainly things like companies adopting crypto. But at the end of the day, I think it's all about the theorization of, and then the development and implementation of interesting, powerful use cases that crypto can really flex its muscles for and see success in order to drive those next few waves.
That's awesome. And earlier in our conversation, you kind of mentioned that these platforms should be focused on developers, and I totally agree with you. I mean, that's one of my major issues with Ripple and XRP is they want retail investors to hold something they have no use for, but that's for another day. On the developer front, how do you gauge competition here or uptake? And just if you need a lob of an example, I mean, I think we could all agree Ethereum has a ton of developers and Tezos doesn't. But if Tezos were able to capture some of those developers, it could be really successful. I'm just wondering how you gauge competition here.
Yeah, it's an interesting one. I think there's a variety of factors at play here. I think an interesting end metric for that is actually end user usage of applications built on top of those protocols. It's great if you got 100 or 1,000 developers working on things, but if none of those things are compelling enough to have users actually use, then what was the point? And you'd rather have one or two or three or five developers working on really compelling applications on top of a protocol that are going to be used by millions and millions of people than 1,000 developers working on useless things that are not going to ever be used by consumers. So it's actually interesting to me to look at, in terms of what's valuable for measuring developer success, to actually look at the second order effects, going back to those users and saying, well, are people actually using these things? And I think there's a variety of other things around diversity of applications being built, and if there are actually multiple use cases emerging. But I guess in short, I would say I don't know that there's a great single quantitative assessment or single number for which network is winning on developer adoption. I think you have to look at the quantity of things being built, the quality, the end user adoption all across the board. Electric Capital did an amazing developer report that they put out a few weeks ago, comparing developer activity across a bunch of different networks that had a number of different measures for those networks' developer activity over time. I think that's a really good starting place. And just building on that and seeing what happens afterwards is probably the right way to go.
Going back to the developers on the core level itself, how do you think about evolution of these networks? And I guess the one example I give to is, we were just talking about developers, and I know Multicoin and I think Electric Capital pointed out that Litecoin has, no developers on it. The GitHub's a graveyard. Do you view one-off changes to a protocol like that as evolutionary, or do you look more for things that could, say, iterate over time? Tezos and Decred are good examples there, but I'm just wondering how you gauge competition when you look at all of these projects.
Yeah, I think and I hate to give a weaselly answer to this question, but I think it really depends on the project and on the network. And I think some projects are best off never changing. So you could argue, you could certainly make the argument, and I deeply appreciate all the progress that's made on Bitcoin, but Bitcoin's not looking for radical changes at this point. Bitcoin is doing what it's doing, and part of the value is in the stability of it. And other networks, one of their advantages is responding really quickly to changes for certain use cases. And so I do think you have to go back and think about the goals of the network and what's important for that network. I think in some cases, iterative nature is critical. In some cases, relatively limited changes is the right approach. And I don't know that there's a one size fits all answer to that.
No, that's a great point. To be honest, I think certain protocols should be bifurcated too. I think eventually every layer one on these protocols, as they get large, should be resistant to change. But I don't think that should be a sounding board for, say, Ethereum or Bitcoin. You could like both, right?
Yes, exactly.
Just closing out, Andy, is there anything you're working on or that we haven't hit on that's important and you wanted to discuss? I mean, you're definitely at the forefront of seeing a lot of the best projects in the space.
No, I appreciate it. I think we hit on a lot of the really important things. I will just say that I've been really excited in 2019 so far by just some of the interesting things that have started to happen and little projects. Some of them, are just toys, and that's how a lot of great products start off, is as toys and little gimmicks. And so I'm just really excited about where a lot of the stuff is going. I've been spending a lot of time. You mentioned the DeFi space, looking at that space and seeing some of the things being built. And so I would just really encourage people, obviously, go pay attention to the big projects, look at what's happening on a macro level at the space, but also spend some time looking around and looking for more niche little applications and toys and products that are being built. Because that's where, for me, a lot of the excitement is right now around what's going to drive the next wave and seeing the creativity and the output that's going into some of these really interesting things getting built.
No, that's a good point. I believe it was Avicii, or I hate to mispronounce his name. You just mentioned him from Electric Capital. He was on Pomp's podcast, and he basically said that everyone on crypto Twitter now are the real builders because they're still here in a bear market. So you could find some really interesting projects.
That's exactly right. Yep.
Andy, thanks so much for coming on. I hope to have you on again in the future.
Thanks for having me. This was really fun.
Hi, everyone. Thanks for listening to the podcast. Please rate and review it to help other people find it, and visit delphidigital.io and use coupon code CHAINREACTION to access all of our research while this offer lasts.